Hey everyone, just wanted to do a quick intro. I'm Arry, chair of the Cascadia Blockchain Council. I also host a weekly AMA, Ask Me Anything event every Friday, 12 to 1 p.m. PST on Fridays. Sign up at the Blockchain Underground on Meetup if you want to attend any one of these. Last week, we had a really great session with Patrick Larsen, CEO of Zen Ledger.io. He answered so many questions and people just came away totally amazed, having learned so much. And so I've been being pinged left and right from folks wanting this video and recording. So going to do my best to get this posted as quickly as possible. Thank you so much for your support, and let us know if there's any questions or any events or people you want to see, and we'll make sure we get them onto the podcast or into an AMA or somewhere out there. Okay. Be safe out there. Bye.
Thanks, Arry. The webinar is being recorded, so feel free to jump in, ask questions anytime. This is for your all benefit. So if there's anything that's unclear or you have any ideas, just jump in. I'm not a tax professional. I'm not your tax professional, so none of this is tax advice. Feel free to ask anything you want. I may just kind of hedge a little bit and say, oh, this is conservative, this is aggressive, but really you should consult a lawyer or an accountant before you move forward. But I can give you kind of general guidance or what I've seen other people do. Introed myself already. So we'll just talk about Crypto 101, what the IRS is doing, some of the warning letters, a lot of the major trends in the space, how there's still a lot of gray area in taxation and regulation in the United States, but it looks to kind of be firming up as we go. So one big reason you should care about crypto taxes right now, if you're transacting, is this is the first year that you're going to have a yes or no question on page 1 of the IRS 1040 that asks you, did you transact in cryptocurrency this year? And so if you received crypto from airdrops, from payments, from doing consulting or income, if you sold crypto for fiat, kind of cashing out, if you traded crypto to crypto, if you bought Bitcoin with Ethereum, Ethereum with Bitcoin, if you use crypto to purchase goods and services, if you earn income from interest in crypto, those are all taxable events in cryptocurrency. Like buying a NBA Top Shot NFT is not a taxable event in cryptocurrency. But if you sell that NFT for Ethereum or something sometime later, again, that's a taxable event. You don't have to answer no if you just held cryptocurrency. So like 2 years ago, you bought some Bitcoin and you just held it for 2 years and done nothing with it. You can answer no unless you've received airdrops, in which case you have income and you have to answer yes. And it's funny because the airdrops aren't even in your control most of the time. So then there's a question of, did you take possession of the airdrop? Do you want the airdrop? Do you want to report the income on the airdrop? Is there liquidity? Did you receive it on Coinbase, or is it in some wallet you haven't accessed? So again, lots of random gray areas and minutia, but generally, if you're on Coinbase, you're trading, you're buying and selling cryptocurrency, then the answer is, yes. So, any questions there?
Yes, I have a question. So, for example, I have some Bitcoin in Celsius and BlockFi, and clearly collecting interest on my Bitcoin. So, are those, should I be answering? I already answered yes, because my husband wanted to just be on the safe side. He doesn't want to just mess with anything in the future, just right now either. Yeah. So we answered yes, no matter what. But would that have constituted as a event to have answered yes?
Yeah, and you probably KYC'd into those institutions, and then they will probably send you a 1099-B. So again, it's already kind of reported as income to the IRS. So they kind of already have a little bit of a track record on you. But yeah, so if you're earning interest in dollars, then you wouldn't click yes here. But I guess if you, that is another good question. So you send Bitcoin into BlockFi, and so that's that if they take custody, it's left your possession, and it may be construed as a taxable event at that point. So you kind of have to think about these things. I would ask BlockFi what their recommendation is there on how they want you to handle that, because you're losing custody of your Bitcoins out of your possession now. and you have to ask for it and it takes a week to get it back or something, right? So that's something to think about of custodial versus non-custodial DeFi projects.
Hey, Patrick, just to clarify on that, so if I ACH some funds there and I purchased crypto, that wouldn't be, and I didn't sell it, that won't be a taxable event, correct?
Yeah, that's not a taxable event because you've already been taxed on your dollars.
Right.
So that's why they don't tax you again. If you go buy stocks or art or a car or crypto right now with the dollars you've already been taxed on because you earned income on it or were charged for other capital gains, you're not paying that. So buying crypto with dollars is not a taxable event. However, you do have to answer yes to this question because you are transacting in digital currency, you're acquiring digital currency. So they're kind of building up a database of everyone who's transacting in crypto.
Got it. And just one more, so clarifying the NFT, so I'm dabbling in Top Shots too. You notice, I mean, I will check this box because I do more than just Top Shots. But in that scenario, this is just a yes or no question, checking the box. If I made money off of Top Shots, it'd just be just normal capital gains at that point.
Yeah, you'll probably get some sort of like selling stuff on eBay, right? Like there'll just be some output. It's not. I haven't studied Top Shot enough to know if it ever like touches a blockchain or anything. I feel like it
uses flow. Well, it's interesting. Just today, there was an article that securities looking at it to see if it, or SEC is looking to see if those are securities now.
Yeah, that's interesting. Yeah.
Yeah. So it'll be interesting how that plays out. But however you slice it, if any gains, I gotta, whether I get a statement or not from Top Shots, I have to put that on my taxes.
Yeah, but just buying Top Shots isn't a taxable event. But you like, because you're already doing a bunch of other stuff, you're just gonna answer yes here.
Not to get too much into the rabbit hole. So like in this may not be in your realm. So like a trading card, let's say you had a Jordan trading card, a physical one. Does that constitute a taxable event if you make gains off of that?
Yeah.
It does.
Yeah, you can't just barter forever and barter your way from a paperclip to a mansion and never pay taxes on any of those transactions.
Okay, thank you.
The government's in the business of taxing the flow of assets. So is Wall Street, right? So they care anytime things change hands, they're taxing you.
That's what I figured. Okay.
So a little bit more on Crypto 101. Kind of the background here is the United States IRS has continued to kind of wrap its head around crypto over the past 5, 6, 7 years. It first came out with guidance in 2014, but it hasn't come out with much more guidance since then. What's interesting now is at the federal level, you are seeing Secretary Yellen of the Treasury, Mr. Gensler, who's head of the SEC now, they're crypto experts. And then their staffs are going to be really smart in crypto, where every previous executive administration in Department of Treasury and SEC have not been well-versed in crypto. You're seeing other nations like China look at central bank-backed digital currencies, which will force the European Union and the United States to kind of react as well. The United States has kind of just taken a middle road and not really addressed things and just kind of said, hey, crypto looks a little bit like property and we want you to divulge your transactions. We're going to account for it kind of like trading tech stocks or currency sometimes. It'll be kind of a mishmash. And there won't be any like proper congressional laws stating the taxation and regulation regime for crypto. But you'll just kind of say it rhymes with all our previous stuff, and we're just going to move forward. But now you have crypto banks in Wyoming, which means that Nevada and Delaware will probably try to attract crypto banks too, because they don't want to give up, the incorporation to Wyoming. And you're getting all these, Coinbase is, I don't know what its market cap is now, maybe 50 billion, but it is a Fortune 500 company. And you're just seeing, billions of venture capital go into crypto. So more crypto assets, more crypto ventures, 2.5 trillion in total market cap in crypto, 40 to 50 million Americans holding crypto, which is like 1 in 5 or 1 in 6, probably several million Americans hold really significant amounts of crypto, like in the hundreds of thousands or millions of dollars. So it becomes an issue where at some point it's big enough that you can't ignore it. And every tech company wants to be a bank and get into crypto, and every bank wants to be a tech company and get into crypto. So, they'll lobby for some clarity so that, grandma's pension fund can get into crypto. That's what JP Morgan wants. So that's kind of how things are going, right? So I think we've kind of mentioned what taxable events are and are not, but mining, staking, airdrops, all taxable events. Coin-to-coin trades are taxable events. Selling crypto out to fiat or out to another crypto is a taxable event. And interest income, or income for goods and services paid in crypto are taxable events. What is not a taxable event is purchasing crypto with fiat, donating crypto up to certain limits, and gifting crypto up to certain limits, putting crypto in tax-advantaged shells like an IRA is acceptable, just like putting stocks or real estate into or bonds into IRAs is acceptable. And then transferring crypto among your own wallets is also non-taxable. So you move your crypto from Coinbase to a LedgerX wallet to Gemini. That's all non-taxable, and then the transfer fees or the gas fees actually will add your cost basis and reduce your tax liability. So, any questions there?
No,
Scott?
go ahead.
Oh, I was going to. Scott has his hand up.
Yeah, as a matter of fact, I have a question.
Mm-hmm.
You just mentioned about different banks establishing themselves in different states, and as we know, it's advantageous tax-wise to have do banking or establish businesses in certain tax-friendly states.
Mm-hmm.
So is it going to be a similar situation with crypto?
So there will be a difference between corporate taxes and individual taxes. And just because you open up a checking account in a Wyoming crypto bank, but you live in California, probably not going to do much for you. If you're going to establish a Wyoming LLC and build a crypto business there, and you're domiciled somewhere else, then again, it gets a little iffy.
Let me lay a scenario out for you. Let's suppose that you establish a company, either a corporate or some corporate entity or an LLC, in like a state like Delaware, for instance, that is very tax friendly for that situation, and you're taking payments in the form of cryptocurrency. Is there any advantage to being in one particular state over another, like it
Sure.
is?
I mean, so this is kind of out of the scope of personal taxes, but just from a general point of view, you're a corporation, so you're going to manage your profit and loss, and then you're going to manage your federal taxes and your state taxes. And I believe if you're incorporated in Wyoming, I have no idea what their state taxes are. I know there's no personal income tax, just like in Florida. I don't know if there's no state corporate income tax. I know that Delaware is kind of the established law of the land, and every accountant you work with really understands that well and knows how to optimize your taxes from a corporate standpoint. If you're a Delaware C Corp or LLC, I would imagine if Wyoming gets popular, accountants in Washington or California or Texas will get smart on Wyoming law, just like they had to get smart with about Nevada rules. But I haven't looked into it enough to say that it's vastly preferential. The reason Wyoming is attractive is if you are a bank, because you need a state charter to become a financial institution, which is very different from being just some LLC that's e-commerce or SaaS that takes payment in crypto. It's just different.
I realize that this is not exactly the right forum, and it's a complicated issue. So thank you.
Sure.
Hey, Patrick, just real quick on that one. So you mentioned fiat.
Mm-hmm.
Is stable coins the same, purchasing crypto with fiat and stable?
Because a stable coin is not issued by the United States government. And the United States government does not care that your stable coin is pegged to the dollar. It is not fiat. It is not a US dollar. So stable coins are taxable events. Almost always you'll have no taxable gain or loss when you swap between dollars and stable coins, but you will have a 0.5% or 1% of slippage pretty often. And so you may have minute gains and losses as you're swapping between Tether and USDC and BUSD and fiat dollars, so you do need software, or you do need to track all those minor changes. The IRS isn't going to come after you because they're like, hey, look at all these 0.001% capital gains and losses you had going between your stable coins. Like that's not what they're going to get on your case about. It's going to be that, hey, Ethereum 30x'd and you said no, you didn't have any cryptocurrency, and now you're living in a $2 million house and you reported $5 of income. Like that's why the IRS wants to talk to you.
Got it. But trading from, let's say, Bitcoin to a stable coin, that's a taxable event.
Yeah, taxable event. Just like trading from Bitcoin out to fiat is taxable event. But going from stablecoin to stablecoin is actually a taxable event. It's just that if they're both pegged at $1 and they were at time of acquisition disposal, there will be no gain or loss.
Yeah. Okay. Got it. And just to add, so I just recently done my taxes, and I'm with one of your competitors, Coin Tracking, but just feedback is that it's important, especially if you're trading from token to token without a stable coin. It's like really critical to make sure you try to automate the trades into it versus trying to do it yourself. I've learned tons, at least from my last with doing and working with them, just with the little nuances, because timing is everything, of the time of the trade up to the second, because it needs to account for that, the price of that time and day.
Yeah. So our software automatically pulls all the prices for you.
Yeah.
So one of the parts of the automation, then we pull APIs as much as we can. Yeah. So we have the transaction price on the exchange. It's only it gets a little messy if you're doing on-chain transactions. So like, a DAO or something, and it's just priced in Ethereum. And then we have to go pull a couple different market prices at the time of the Ethereum transaction or the Bitcoin transaction, and saying like, hey, that transaction that happened in 2016, it was never priced in dollars, but here was the dollar price of these 5 exchanges for Bitcoin at that time.
Yeah, and it's
automating that for you.
I think one thing where I've been in this space for a while, but I hear a lot of people trading gets a lot of taxable events. So I think just being mindful of that, when the more trades you do, the complicated it's as far as taxes go. So unless you're a hodler, it makes it much easier when it comes to it. So just something to keep in mind for new traders that are coming in. So
yeah, and it does get pretty dicey or complicated. So the IRS guidance is first in, first out is the most conservative approach.
Okay.
If you can specifically lot ID every single crypto you purchase, and they allow that on exchanges, you can get to a more aggressive accounting method like last in, first out, or highest in, first out. But so far, the IRS really hasn't given anything except first in, first out its blessing. So you do probably increase your chance of audit and a bit more of an adversarial exchange if you decide to go with a more aggressive accounting method, just like in anything else, right? If you're trading wood and you change the accounting method and you get aggressive with it, the IRS might come after you if you're like a $1 billion lumber company. So just some things to think about there. Forks, so hard forks are considered taxable events. Like you get airdrop Bitcoin Cash, that's a taxable event. You got extra coins from nowhere, so they had zero cost basis. They're like pure income. They had liquidity. You could have sold them at any time. So hard forks where you have, Ethereum and Ethereum Classic, Bitcoin Cash, those are taxable events. Soft forks where they just kind of switch over and they go, here's a 1-for-1, here's a token. You can kind of classify those as not taxable events, or even when it's like vet and you're like, hey, 10,000 to 1 or something, but it's still like the cost doesn't change. So your like overall like dollar holding of that asset doesn't change, then that's generally considered not a taxable event. And then, mining, staking, interest income, those are all taxable events. If you're doing this at scale, if you're a trader, professionally trading, or you're a miner and you're mining all the time, then, like maybe it's your LLC doing these business activities, and there's different accounting and tax rules. So again, something to think about if you're just doing some ASIC mining at home versus like having a warehouse full of rigs, or if you're just doing a little bit of trading at home, a couple trades a day, a couple trades a month, versus like high frequency bot trading, millions of trades a year. There's different accounting rules, and you should probably have a different legal structure and some different legal advice around your crypto activities.
Hey, Patrick, real quick on the airdrops portion, is it taxable when it hits your account, or just only when you sell it?
So both. It's awesome that way. So say January 1st, you get an airdrop. So you have you get $100 worth of coin A, on January 1st, that's $100 of income taxable to you at your income tax rate. Call it, 30%.
Okay.
And then you hold that one coin that was worth $100 for 6 months. And then 6 months later, you sell it for $120. You now have $20 of taxable gain. You held it for 6 months. So it's a short-term taxable gain of $20. And that $20 of taxable capital gains goes into your pot of capital gains or capital losses as well.
Okay. Got it. Thanks.
So that is, that's the problem with free money, is they don't mind taxing you twice on it, just like a stock dividend.
Right.
You would, if Tesla goes, hey, everyone gets an extra share today, you get taxed income tax on that extra share of Tesla. And then when you sold it, you would be taxed on any capital gain you got from that extra share of Tesla. Or GameStop. I guess I should be saying GameStop when we're doing crypto.
Yeah.
So yeah, and the IRS is stepping up enforcement quite clearly. They're going, SEC and IRS are going after John McAfee. They're going to subpoena all the ICOs John McAfee worked with. They've sent out tens of thousands of warning letters. They've increased the John Doe summons. They successfully sued Coinbase in 2018. They're going after Kraken, Poloniex, Circle, and then some basically every US-based exchange is kind of turning over 1099K information, which is like your aggregate trading activity. If you trade one Bitcoin back and forth really fast, 20 times, you'll have $1 million of 1099K activity. You'll probably have a small loss, right? But the 1099K won't say that. It'll just say $1 million of trading activity, and then the IRS will be like, hey, we're going to send that person a warning letter saying, hey, we see you have significant crypto trading activity. This is just a reminder that you need to pay your income and capital gains taxes on crypto. Or they may have more stern warning letters that basically go up to, hey, you have 30 days before we proceed with a criminal investigation if you don't reply to this. So it kind of ranges, so from shaking the tree to knocking on your door. So those are, you can very clearly see that US federal government, IRS, are getting much smarter about how they think about crypto, how they monitor crypto, how they demand crypto is reported from cryptocurrency exchanges. Everything's getting KYC, AML now. I think Aave, classic DeFi, also asked for KYC, AML now. MetaMask did, I think, I remember, which was another, can't remember. It was one of those where every hardcore crypto person was like, oh no, we lost another one. This one hurts. So there's not a lot of places to hide here. Which is fine when everything's just mooning. If you get a 30x, then no one feels too bad about paying taxes on it. What you get to is bad situations where you're like in 2017, 2018. In 2017, people are just making gains like crazy. And then right at the start of 2018, the bottom dropped out. So you lost 95% of your portfolio value. But 2017 taxes say you have $1 million of gains, but now your entire portfolio is worth $10,000. And so you're left with a gigantic tax bill that you cannot pay because everyone was doubling down every time, right? They weren't making a trade, making profit, and setting aside 30% to pay their taxes and then investing the remaining 70% and doing that again. They were going double down, 100% back in. Oh, I doubled it? 200% back in, double down again. That's all that. So that's why a lot of people are left with very large tax burdens. So that's something to consider as well. If you're going to be an extremely active trader, if you're investing in DeFi protocols and they're going up a lot, you should be setting some aside. You should be taking profits, and you should be setting some aside and trying to get kind of a real-time running of your tax implications. Hey, if I didn't trade anymore today, how much am I going to owe in taxes next year? Which is something our software can always do for you. You can run your reports any day of the year and see what your current tax liability is.
Hey, Pat, Paul has a question. Quick question from Paul. He asked, can Zen Ledger calculate profit and loss transactions that happen through a swap site like Uniswap?
Yeah. So we support Uniswap 2.0. We'll support Uniswap 3.0. If you get into really esoteric things, then we may not have added that integration yet. But all the popular things like Uniswap, we already integrate with. We integrate with, basically hundreds of exchanges and wallets, and obviously thousands of tokens at this point. and if we don't specifically integrate with yours, we can always figure out a way to create a quick custom spreadsheet or something so we can ingest your transactions and still get it done for you. So Uniswap 2.0 we support because it's just through your MyEther wallet. Same with Sushi and a bunch of others, Paraswap and Zappify and a bunch of other silly named crypto projects. So yeah, we support a ton of them.
Right. And then Scott had a question.
Yeah, again, this might be outside the scope, so let me just lay the question out. Actually, Paul and I have been discussing this. How do I put this? There are certain cryptos that are not tradable right now in the US markets, in the US exchanges. Certain ones of these cryptos I would really like to get into because they're doing phenomenally well. So I know that you can't address the legality, and you're really more looking at the tax side of things. So if we invest in what I would call a foreign exchange or a foreign market, would that be considered a foreign investment from a tax standpoint?
So like say you had a Binance account, even though you can't anymore.
Yeah, I found out that the hard way.
Yeah. So if you have holdings of more than $10,000 of peak holdings on any second of the year, you have to report all your overseas holdings to the Department of Treasury, FinCEN. And our software helps you do that because you can just tag things as onshore or offshore. Most things are onshore. Coinbase is onshore, Gemini's onshore. All your wallets are onshore because you're onshore. But if you specifically set up something to be offshore, you're like, hey, this wallet, I'm going to say is in Monaco or whatever. And then you're trading in Huobi and Liqui and Binance, and those are all clearly custodial exchanges overseas, then you should be marking those as overseas. And if you want to be a US citizen, US taxpayer, then you need to be, divulging those overseas holdings and working on them. There's no overseas holding that you can't hold. It's not like it's ivory elephant tusks. The United States doesn't care that you're holding whatever the illegal version of ABC coin is. What they care about is that ABC coin can't market an ICO to American citizens, and that's why they draw a line around it. Or Binance cares that they don't want to deal with the SEC, so they say they don't want to deal with Americans. But if you're an American and you're trading on Binance and you're making profits there, America doesn't care that it was, not legal, because that's not even what's happening. They want you to report your overseas holdings and your overseas gains.
I'm just concerned about inadvertently doing something that's going to get me in trouble.
There's no you're not going to buy Iranian sanctioned bonds on accident on crypto. There's nothing actually illegal or criminal you can do by trading on foreign exchanges, as long as you're claiming the profit and loss and paying your taxes.
Okay.
But eventually, but eventually there will be Iranian bonds on there.
Perhaps, yeah. I think there's a reason North Korea hacks exchanges and wants to get a hold of cryptocurrency for hard assets, and Iran or Russia are definitely using cryptocurrency to get around sanctions. But that's not your problem as an individual tax holder.
Also, if you report that you're on Binance might just close your account and not release your funds, like it happened to a friend of mine. He put in some Bitcoin, wanted to get some altcoins, did 3 transactions, 2 went through no problem. On the 3rd transaction, they said, oh, this looks suspicious. We want to verify your identity. And when they said, we want to verify your identity, he couldn't do it because he's a US citizen. They wouldn't release his funds anyway. So now all his funds are hanging there with no access for him.
Yep. So that's the classic.
If you file taxes.
Yeah. It's so you would claim that as lost or stolen, you no longer have possession or control of that crypto, so you write it off. This is a classic case of not your keys, not your crypto. So you took a risk by giving custody to someone else and trusting that they would give you custody back if you asked for it, and they didn't. So that is a problem.
Thank you.
I have a couple more questions about CoinDesk, Zendesk. Back talking about the swap sites, you said that you support Uniswap. I use MetaMask. So if I actually did quite a bit of trading with Uniswap in the early days. Is that like Uniswap 1.0? And
so all you're going to do is you're going to grab your Ethereum address from MetaMask, paste it into our software, and we'll run it for you.
And it'll follow all the transactions back and forth all through the chain like that?
Yep.
That's great. Here, how about this scenario? I bought one Ethereum in 2017, and I moved it off of Coinbase. Now it's 2021. I moved that Ethereum back to Coinbase and sell it. Now that's a taxable transaction. And as long as I put in the Coinbase API key, your software will associate those two as a single transaction?
So no, it's multiple transactions. Some of them are non-taxable events, but you had gas fees. So we'll capture the gas fees and add that to your cost basis to reduce your taxable income. But when you used a first in, first out accounting method, if I just buy 10 Ethereum on Binance in 2015, and then I buy 5 more Ethereum today on Coinbase, and then I sell those 5 Ethereum, first in, first out says you're selling the Binance Ethereum from years ago first, and our software will capture that for you.
Okay, but
it'll keep it completely coherent, even though it's on different exchanges. If you upload both exchanges, both APIs, we have all of your transactions. We'll correctly go to the correct cost basis and timeline for what you need today.
In terms of Binance, I opened up a Binance account very early on, had a lot of coins, and then they kicked all the U.S. Residents off the original Binance, and I had to remove my coins. And now I can't log into that Binance account anymore, so I don't have those records. Is that a problem?
It's possible. So you'll kind of need to do an analysis, right? Use our software or someone's software or a tax professional and run it and see if you're missing any transactions. If you are, you may have to come up with a plug, right? So you'll have to say, oh, here's 1 Bitcoin that left Coinbase in 2017. I remember it went to Binance, and then I got half a Bitcoin back from Binance when I closed it out. And then you have to take the value at different times. There may be like whatever, a $3,000 capital gain, even though the amount of crypto that came back is different. And that's the accounting you're doing. Everything comes out to dollars. Like the United States doesn't care that 1 Bitcoin went out, half a Bitcoin came back or anything. They care that $1,000 of an asset went out and $2,000 of the asset came back. That's what they care about.
So if I only have some maybe quick notes that I took from a transaction and there's no record of it, can I just take the average price for that day and use that as a guesstimate? Is that allowable?
Yeah, there's all sorts of different ways to kind of do a plug. And again, this is getting into forensic accounting, and like you should, if the stakes are high enough, you should engage a tax professional. But this is common, right? There are plugs that are made in accounting transactions all the time when you're like, look, I don't have the receipts, I don't have the transaction history, but basically what happened is 1,000 went out, 2,000 came back, and that makes the rest of the accounting coherent. So that's what we're going with. And then you would just keep going. Like you make your best effort based on the records you have, your recollection. It's clear that, like if you get audited and they point to that and they're like, hey, there's 100,000 of gains missing, like, and you clearly made this plug so that you could maximize, could minimize your taxable gains, then that's going to be an issue, right? But if you get audited and that was like the correct plug and it comes out correctly and the accounting's right and the auditor agrees that that was the correct plug, then you're fine, right? So it's very case dependent.
Okay, thank you.
I had a quick question.
Yeah.
So I'm just wanting to talk a little bit more about capital gains. Like the way that I'm thinking about it is like if you purchase virtual currency and the price goes up, you're not going to calculate that as capital gains or report it as a capital gain until after you've liquidated it. So like once there's a sale and you can calculate like a net gain or loss, then that's the time then like that would become taxable. But like, so you talked about like, you know, if you buy Bitcoin and it goes up and like there's a potential for tax on that, but then the next year it goes down, you won't be able to afford the tax on that. So like if you haven't liquidated the money, you haven't realized the capital gain. So I guess I'm trying to get a better understanding of what you meant when you were talking about that.
Yeah, so the thing I was mentioning is people being extremely active with their trading, making a lot of gains, creating a lot of taxable events, you know, earning a lot of capital gains, but then not setting aside the taxes, setting aside the cash to pay for those capital gains. If you're not incurring capital gains, you don't pay taxes on it. So if you are, you're not trading, right? So if you bought $10 billion of Ethereum 2 years ago, and now it's worth $300 billion of Ethereum, you never sold it, there's no taxable events. Like if you live in the Netherlands or something and there's a wealth tax, then it's different. But in the United States, there's no tax on market rate of assets. There's only tax on taxable events, disposal of assets, right? You buy a house for $100,000 and you sit in it for 50 years and it's worth 10 million, you don't get taxed on the, you know, the $10 million value of the home unless property tax like comes and reassesses it each year. Can I
ask a couple more questions? So if you
sorry,
never
hold on. Brian, did that answer your question?
Yeah, thank you.
Okay. Please go ahead.
So if I never take out the crypto as cash, but only spend it on goods, then I never have to pay capital gains?
No, that's incorrect. So when you spend crypto, it is a capital event. So if you buy Bitcoin with dollars and then you try to buy a house with your Bitcoin, you're going to pay a capital gain.
No, I understand if you buy a house, but if I just use it on overstock and buy a bed or something, or you know, dog's food. Every
bed
time
is just a cheaper good than a house. It's still a taxable event.
Right. So every time I buy dog food on overstock, I have to pay capital gains?
Yep.
Fuck.
It's very inconvenient. It's just like if you were buying dog food with Tesla stock every time, you'd be paying a capital gain every time as well. And
the other question I have for you, for my friend who still have the unaccessible funds on Binance, he can write it off at for the price he paid for it, or for the price it's worth now?
No, the price he paid for it. So if he bought Bitcoin for 1,000, he puts on Binance. Bitcoin runs up to 10,000 and then shuts off his account, and there's $10,000 of Bitcoin in Binance. He doesn't get to claim the $10,000 loss. He claims the $1,000 loss. He claims what he paid for it, because there would be a lot of fraud if you could mark up the asset and then claim the loss at the marked up value. So you always have to claim it at the amount you paid for the asset.
Other question I have for you: if you once fill out taxes where first in, first out, do you have to stick with that scheme for the rest of your life, or only for that year?
You should stay consistent as much as you can with the accounting method. If you change the accounting method, you have to justify it. You'll need to write a paragraph or something that you submit with your taxes saying, hey, first 5 years I was FIFO, now I'm switching to LIFO because this reason, signed me and my CPA.
What is the reasonable reasons that they would accept?
There aren't any that I know of, because mostly it's, you're switching to something that's going to be advantageous to you. And then you're probably going to try to restate the last 5 years and say, hey, I overpaid my taxes by $300,000. Hey, IRS, send me a $300,000 check, right? And that's going to trigger some flags, and you're probably going to become an audit target at that point. So you're going to need a very good reason. You're going to need, you or your CPA are going to have a very well thought rationale for why you're changing the accounting method. And, it's not going to be just an easy, like, oh, sounds good. Best of luck to you. If it's significant difference, they're going to take a hard look at it.
So can you give us like an example of a good enough reason for them?
No, I can't. The IRS doesn't have like very hard policies. They don't have like a list of examples. I haven't seen, like, I'm not sitting there in IRS tax court seeing a bunch of people like get audited and say what the difference is. Like it's between you and your tax professional for deciding on a rationale.
So let me ask you a different question. I don't know if you ever heard of Pork Fest, but we get together every year and we only use crypto for a week.
Mm-hmm.
Every single time we buy a burger or a cup of coffee, it's a taxable event that for the last, we've been doing it since 2009.
Yeah.
Am I obligated to go back and remember every cup of coffee I ever bought?
So by the strictest of legal definitions, you are obligated to. But from a practical standpoint, yeah, that's again like a decision you should make. It's probably not going to be a huge difference, right? And first in, first out, there's probably not,
I mean, there is a little bit of a difference because if we bought it in 2009 at 20 cents and I bought a cup of coffee, 2 years ago or something, it was the little different price, right?
Yeah. So yeah, like they're by the strict letter of the law that you pay capital gains every time you liquidate crypto and exchange it for a good or a service or fiat or another crypto.
Wow, that's amazing.
Yeah, so it's not the best system.
So you can't use crypto as regular money.
It's not money. Money is issued by governments. Crypto isn't issued by a government. It's not money. No one ever said it was money. Crypto people say it's money. Governments don't say it's money.
Mm.
I guess I'll ask a question. Patrick, can you talk a little bit more about compliance with Zen Ledger? So that's one thing that I've been thinking about is trying to find ways to make compliance simpler and easier on the security side of things. And I'm looking at doing that a little bit more on the tax side of things as well. So I'm just curious sort of how you guys think about, right, because that's sort of like I guess what I'm understanding is like the value is like, if you use us, then you'll be complying with federal tax laws. So there's that protocol already built in place. So I'm just curious how you think about that, and like for businesses, particularly, not for individuals.
Yeah. So if you're gonna start a crypto business, then you're gonna want a crypto CPA and a crypto lawyer to make sure things are set up and running the whole time. Especially if you're issuing tokens or someone issued you tokens, and then you're spending those tokens as you go. And you're buying the lease, you're buying the printer, you're buying the internet with, you're selling algos and paying with dollars things, right? So you're gonna have to keep those books straight and your financial statement straight the whole time you're going. As an individual or as a firm, like you want to start from day one knowing what you're transacting. So every time you make a transaction, it's being priced correctly, and you can just run a quick financial query to know what your holdings are. So from a personal standpoint, you can like go in today or whatever, hook up all your stuff to Zen Ledger and be tracking it. And then anytime, if you're not trading often, you can take a look and be like, oh, like, so today I want to go buy, $1,000 of Ethereum. Looks like I have $1,000 of tokens that are trading at a loss right now. I'm going to go sell those. And therefore, I'm not going to pay any capital gains because I sold my stuff that was at a loss. And then I'll go buy my $1,000 of Ether. You can, that's like something you can do in real time, or you can tax loss harvest, wait 30 days or wait till the end of the year and tax loss harvest, or you can look at what's trading at a long-term capital gain versus short-term capital gain. So like, say you need to free up $1,000 in cash, you can look at the stuff that's trading at a loss to sell for that 1,000 that you're going to take out, or you can look at the stuff that's trading at a long-term capital gain to sell for $1,000 to trade out to fiat before you sell the stuff that's trading at a short-term capital gain.
That's really smart. Okay, I see what you're saying. So essentially, Zen Ledger can hook. So like, let's say I have, an Ethereum account or a Ethereum wallet, a Bitcoin wallet, and an Algorand wallet. If I sign up for Zen Ledger, then it'll aggregate all of those wallets and information into a single platform that will allow me to then also analyze the tax issues that I have.
Yeah. At any point, you can produce a full audit report, which will just tick and tie everything together. fiat to crypto, crypto to crypto, self-transfers, build your A949 every single taxable event with the accounting method you selected. And you can also get a tax loss harvesting report, which by accounting method, by lot, by coin, will tell you what's trading in a long and short-term capital gain. So say you own 10 Ethereum, it'll say, hey, the first 6 are at a loss. You can sell those 6 and you can capture loss. But if you sell any more than 6, if you sell 6.1 Ethereum, that 0.1 Ethereum will be at a profit, and you'll own profit on the 0.1 Ethereum you sold.
Yeah, that's really cool. So can you tell me like a little bit more about, like, I guess how long have you been working on the on Zen Ledger, and then like what are the pricing models that you guys use?
Yeah, so you can go to our website, zenledger.io, and see what the pricing is for you. We have prices ranging from free to $400 a year. We also work with Andrew Gordon's accounting and law firm, and you can purchase time from his accountants and lawyers to help you as well for more of a done-for-you service. So our software is more of like a TurboTax for cryptocurrency. It's self-service, but we also have customer support to help you all the time. But if you really want, like, hey, I want you to file this for me, I want a professional opinion, then we work with Andrew Gordon right now to supply that.
Oh, this is really awesome. Thank you for your time. I appreciate it. Yeah,
and we've been running since 2017. We're venture backed, 20-person firm. I'm in Seattle, but we're kind of a remote first team. We've handled thousands and thousands of individuals and tax professionals. We work with Big 4 accounting firms, ultra high net worth practices, and just billions of dollars of asset value have gone through our software. So.
Do you have a colleague in Massachusetts?
We do not. We have VC firms based in Massachusetts, but we don't have any team members in Massachusetts.
You mean okay.
Do you mean like, do I know a CPA in Massachusetts you could work with?
Yeah, because I'm getting really confused with that. And if for the lawyer, can I ask at least Patrick to recommend somebody, because he doesn't practice law anymore? For accountants, I don't even know where to go to.
Yeah. So a lot of our customers actually just create their own A949, give it to their CPA, because they're generally like they've been working with the same CPA for 20 years and the CPA doesn't know anything about crypto. And so they just go, look, here's an A949, just put it in with my stocks and my real estate and just file it. There are CPA specialists, and you can probably Google that in Massachusetts if you want to like be able to walk into the office. But a lot of CPAs now that are specialists are just somewhere, and you just kind of need to be okay working with a guy in Chicago. And because in the end, there aren't going to be too many ins and outs at the state level that matter nearly as much as getting the federal return correctly.
Yeah. But do I still have to pay? Federal. So in Seattle, do you have to pay Washington state taxes on your crypto?
No, there's no state capital gains.
Oh, okay. Thank you. Sorry about that.
Everyone, we have 5 minutes left, so I just want to be conscious of time. Patrick, would you be willing to share your information or how people can get in contact or learn more about Zen Ledger, or if they have more questions, or we can definitely have you come back, in a future week and do more crypto tax, because it sounds like this is a really hot topic. Yeah, so Patrick, zenledger.io, he has email hello@zenledger.io. And look there's a 15% off discount code. So use webinar 15 for Zen Ledger, redeemed by May 17. All right, so go check out zenledger.io. And then I guess any parting thoughts? Patrick?
No, it's a complex, great topic. There aren't a lot of great answers, but I would just recommend get your books in order from day one, capture your transactions every month or every 3 months so that, it's not a stressful event for you. Everyone's terrible at this. Everyone procrastinates, but it's just way easier if you keep your books up to date. Especially, I think we're kind of more out of the Wild West now. But it used to be every month or two, some exchange would just go kaput and a bunch of people would lose a bunch of assets. You do get some DeFi rug pulls still, right? So I would just keep things as current as possible, because you can make smarter trades. And then you can also relieve the stress on yourself during tax time if you keep things current.
Cool. Well, thank you everybody for joining. Definitely check out zenledger.io. Thank you, Patrick, for your time and answering a million questions. It looks like there's a lot of questions. So, he's actually active on Twitter and, social media. So go and find Patrick. Actually, Patrick speaks quite often too. So, there's a lot of events that Patrick speaks at. And so very well-known guy in the crypto and Seattle scene. And
because I never try to sell someone a token, so you can trust me.
Yeah, he's not selling tokens. He's selling you how to be in compliance. But thank you, everybody. Good seeing you all, and see you next week. Next week we're gonna have a chat about Bitcoin mining. So if you're interested in mining or crypto mining or have any questions around that, that's the topic for next week. And then again, the week after that, we'll be in Miami. So in-person meetup for that. Woohoo! For anybody in Miami.
I'm sad I'm going to be missing it. I scheduled a road trip to some national parks, and I didn't realize
no.
So family time before Bitcoin crypto time. So
good. Family time, very good. Yeah. Okay.
Thank you so much.
Bye, everybody.
Thank you. Bye.
Thank you.
Bye.
Thanks for tuning in. This podcast is non-technical, fun, informative way to learn about money, Bitcoin, blockchains, crypto, and digital assets. This podcast is not financial advice, and your reactions are your total and complete responsibility, y'all. Now, thanks again, and enjoy the show.
What are you doing?
Stuck inside.